quick little brush test. What's up, everybody? J Capital here. Today, our lesson will be on bonds. So, guys, what are bonds? You probably know what bonds are, right? I am too. So, you become the bank. You loan money to the government, city, state, and corporations. They also have fixed periodic interest payment, also known as the coupon. The coupon is how much of interest you're going to get paid for the year, guys. When the loan reaches its maturity date, that is when the loan is officially paid off and they don't owe you no more. The face value is what is you paid from the start. So you buy maybe an Apple bond because we love Apple, that's all we talk about. And at the end of the year, say you had to pay $10,000 for one bond. Okay, so you made that money on top of that plus interest, guys. It's kind of a cool investment, but it's also boring. We don't like boring. We like big dollars here, right? We don't want interest payment. Maybe when we're older. Why don't they borrow from the banks, right? They don't borrow from the banks because they have restrictions. Also because interest rate companies pay bond investors often less interest rate from when they require for obtained from a bank. I'm here. God damn. I'm getting upset because I don't like bonds, and I gotta teach you guys this because it's so simple, but I still love you guys. I really do. I appreciate you guys' love and support and the questions you ask me. Why companies don't really like bonds is because it cuts into their profits at the end of the year. So they really don't like that. Okay. Swing them. God damn. I love you guys. You guys are what types of bonds there, right? Okay. You got treasury bonds, you got high yield bonds, you got corporate bonds, municipal bonds, just to name a few. So we'll start with, this is, guys, we're getting bit by mosquitoes right here for your knowledge. We're trying to get you guys up to par here. So hold up. Brush break. I love teaching you guys, I really do, but I want you guys to be able to understand it. We basically do all this stuff so easy that a baby can understand it. That's why we do this. Beard break is over. Types of bonds, I already mentioned. So we'll go over one. TBill is a short term for debt obligation backed by the government. Okay? So a TBill has a maturity of 1 year or less, and it's usually sold in increments of $1,000. So, like my associate says, if you're young, you want to put your money elsewhere for higher potential, invest in stocks. We're young, we don't like bonds. Maybe when we're older and we have our millions, we might consider investing in bonds, guys. So, come here. Next one, Tino's. So Tino's government debt, which fixed interest rate with a maturity of 1 to 10 years. Listen, if you have money and you want it to be locked up for 1 to 10 years, and something comes up, you're gonna need it, and then you're gonna pay high fees, and then you gotta pay tax on top of that. So if you want to dip your fingers in that, I'm not gonna tell you not to. Go ahead, everybody's a different type of investor. Okay, like I said, it's all backed by the government. It's the safest one you got. And we got T-bond. 10 to 30 years maturity. These are the safest investments because, like I said, it's backed by the gov. I just said, high yield, also known as the junk bond. This is lending cash to a less dependable company with a horrible credit rate. What are we trying to get on my brush break? So, don't be getting on the waves, kid. Look at the ocean real quick. Get a picture of that ocean. Guys, we love this scenery here.
No other choice we live in.
I know, we live here. We just got kicked out. We're teaching too much sheep. Back to it. Junk bonds. The worst. They also pay the highest yield because they're risky. Do you like risk? I do. They got municipal bonds, aka almost minus bonds, I call them. This is lending cash to city or state for projects like streets, schools, sewers, and stuff of that nature, guys. Okay? Thank you. So corporate, I just want to see all of that I wrote down for them. Guys, I do this. It took me like an hour to think of all this stuff. I love you. Corporate bonds, debt security. I keep saying that. All the bond is debt. That's it. You become the bank. That's bonds 101. You're the bank. That's it. So all this is backing basically by promises. I don't know if y'all trust the government like that. If you do, go for it. Whatever. You're probably wondering next, why bonds versus stocks? Which has better returns, guys? bonds are loaners, stocks are owners. Ooh, gives me the shakes. Okay, so stocks tend to earn better returns than bonds. Think, what was the average market return last year? Probably what, 7, 9, 10%? Up over there. Bonds are more conservative investments. Something, look, I wrote this, something your grandpa owns. I don't know if that's what you like. Bonds are backed by promises. Listen, that's cool. Stocks can pay dividends. Stocks can also appreciate. Your bonds, not so likely. Oh, another cool thing about bonds, this is the only thing that's cool about bonds, is sometimes you don't have to pay state or federal tax on them. When stocks go up, the value of bonds drop. When stocks go down, that's when you might investing in bonds. I don't suggest it because bonds are stupid. I don't like them. AAA, low risk. I'm not even getting all that. A is usually low risk, B is medium, then you got C is highest risk, also known as junk bonds. That's cool, guys. It's really cool. What type of risk do you have to worry about? Interest, inflation, credit, all that juicy stuff, guys. So at the end of the day, do you really like bonds? So if you don't have $10 million or more, don't invest. Go into stocks because they offer high potential, high reward. Also, it can do risk. This only risk if you don't do your research, okay? I am myself a long-term believer of buy and hold, okay? I have index fund that I own since, what year is it? 2019, since 2016. So I just got started on the index wave. So guys, I did all this for you because I want you to understand how easy it is to invest because they make it harder than it really isn't. Because it's not hard. If you read books, invest in yourself, you can become a good investor. Look where I'm at. New spot every day. But guys, quick review again. What are bonds? Bonds are loans. What are stocks? You become owner. What did I say with that heat thing? Bond owners, stocks owners. Make sure that gets fired. You got treasury bonds, high yields, corporate bonds, municipal bonds, all that. There's also foreign bonds, U.S. government savings bonds and stuff like that. We maybe get into that next, maybe part 2. No? You like bonds though? Yeah, they're cool, right? They're kind of cool. Maturity, like I said, is when the interest paid off, the coupon, interest payments, then you have the face value of what you bought it for. So, guys, that's basically Bonds 101. That's basically right here. It's probably 600 pages in a book, but they milked that. They really milked it, just like I'm doing right now, guys. So, yeah, guys, make sure you like and subscribe to our channel because we're dropping videos all the time. I hope you guys can learn something from this because if you didn't, we're not doing our job, guys. So, like and subscribe. Also, send us some DMs if you have any trouble with investing. We'll get back to you. Psych.